If you're serious about getting a great deal when you're buying a home, you need to know about this one mortgage program that most people totally overlook or simply don't know about. Now, this program is called the FHA 203K loan, and once you understand the power of this loan, you're not just going to be able to look at home buying a lot more differently, but also you're going to put yourself in a position to increase your wealth tremendously. Now, in this video, I'm going to break down absolutely everything that you need to know about the FHA 203K loan, how it works, advantages, disadvantages, and what you need to qualify and more. So you've probably gone home shopping and you still haven't found a great deal because maybe this real estate market kind of sucks, because it seems like every house is just way too expensive for what it is, or maybe the new construction homes are even more expensive and they just look pretty boring, pretty cookie cutter and overpriced, and you know you're not really going to get a great deal here. But what if you find a house that's not in a great condition, but it has some good bones in it and in a great neighborhood, and now you're thinking, how can I buy this property and turn it exactly into what I want? Or maybe, hey, this house has a great potential. If I buy it at, say, $300,000 and I put $25,000 worth of work into it, I'm thinking it may be worth $350,000, $370,000, etc. And see, this is where the FHA 203K loan comes in. So let's talk about it. What exactly is this FHA 203K loan? Now, I want to make it, guys, very simple to understand. So this FHA 203K loan is pretty much a subset of a normal FHA mortgage. And the FHA loan is probably the most popular home buying program, or second most popular home buying program. It's just a government insured mortgage, very, very popular among first-time home buyers, or those who don't have a great credit score, or those who don't have a ton of money to buy a house. You've probably heard before, maybe from people, that you need 20% to buy a house, even though it's not necessarily true, because with the FHA loan, you just need a 3.5% down payment of the price of the house. So imagine if you were buying a $400,000 home, which is your typical price of a starter home here in America. Well, if you need a 20% down, you will have to come up with $80,000 for a down payment, whereas the FHA loan only requires 3.5% or $14,000 in this case. Now, the FHA 203K loan is the same program, but with a rehab or renovation twist, because it allows for financing the renovations or the repairs into the mortgage. And as a mortgage broker, one of the biggest questions that I get from my clients who are buying a home is, can I get additional money to do X, Y, or Z to the house after I buy it? Well, with the FHA 203K loan, you do. You can get a lot of money. In fact, I'm going to tell you more about how much later in this video, so stick around. However, with a 203K loan, you can do things like alterations, reconstructions. You can remodel a kitchen, bathrooms, bedrooms, etc. You can add a bedroom, you can add a room, you can add closets, you can put custom closets, you can do adding energy efficient things like solar panels, you can do roofing, you can do gutters, downspouts, you can do landscaping work, you can do electric, plumbing, wells, septic systems, HVAC replacements. You can do things like modifications for disabled individuals, or you can repair a deck, a patio, a porch. Like literally, you can do a bunch of stuff. The only thing that you can't really do is like put a pool or maybe build a gazebo. So like vanity projects. But besides that, I mean, you can do pretty much to a house, with the exception of maybe tearing it down completely and restarting it. But I've had clients who have done very close to something like that. So there we go. It's a lot of stuff that you guys can do with the FHA 203K loan. Okay, so now that you know what the FHA 203K loan is, the next thing that you guys need to understand is that there are actually two types of FHA 203K loans. Now, let's say that you found a really nice house like this one. Maybe the carpet is a little outdated, maybe, and it's a lot of stuff, you know what I mean? And you want to tear all this stuff up. Maybe you want to put some hardwoods, but that's just about it. Nothing major. Then if that's the case, then the limited FHA 203K loan will be the right one here for you. And basically what the FHA limited 203K loan is that it's designed for minor or simple improvements. You're going to use this loan if the total cost of the project is less than $35,000. But now what if the house needs a lot of work? Like you need to tear down a kitchen, got the floors, electrical, plumbing, roof, major stuff. Like you see this house here, for instance, that needs a ton of stuff, and you want to turn into your vision, right? Your palace. Then what you want to do is you want to use the standard 203K loan. And basically the standard 203K loan is for major rehab or structural changes that cost more than $35,000. And for this one, you're going to need to employ a HUD consultant and a GC for the project when you're getting the standard 203K loan. I'm going to tell you guys more a little bit about this later. Now, at this point, you're probably wondering how much money you can get to rehab a property. Now, obviously, with the limited 203K loan, you're limited to $35,000. Now, the upside of this loan is that it's just a little bit faster than the standard 203K loan, and you won't need a HUD consultant. So that's going to save you time, and it's going to save you some money because it does have a cost to hire a HUD consultant. But if you are looking to get the standard 203K loan because you need more than $35,000, you would be able to take out a mortgage up to the maximum FHA loan limit in the area. For example, if you live in a high cost area like Los Angeles, the FHA maximum for a single family home is $1.2 million, and it goes up to $2.3 million for a 4-unit property. However, I live in an area that is not high cost, and most of the areas in the country will somewhat be kind of where I am. I live in Atlanta, Georgia, and the FHA loan limit for a single family home is $688,850. So let's say that I found this house in Atlanta and it's selling for $444,000, but based on my analysis, I'm going to need maybe about $150,000 to turn it into the vision of what I want. Then with the FHA standard 203K loan, I could get a mortgage up to $570,000, which is basically the purchase price plus the rehab budget minus the 3.5% down payment. And by the way, this would just be one loan, one interest rate, and one payment. You're not going to need a second mortgage. You're not going to have a second interest rate. You're not going to have two payments. It's just one loan only. Now, I know this video is mainly geared towards those who are buying a house, but I should say this as well. You can use an FHA 203K loan to refinance a property. So if you are already living here and your home needs a reno or maybe something major like broke, probably your AC unit went out or your roof, and your insurance is not going to cover it, then you could refinance your current mortgage with the FHA 203K loan and roll the existing mortgage and get the rehab money into one new loan. All right, hopefully you guys are still here with me, and I'm about to wrap this video up, and I want to talk to you guys about how to qualify for the FHA 203K loan and what you need to be aware of so that you can have a successful transaction. Now, the first one is credit scores. Obviously, you're looking to get a mortgage. You're always going to need a credit score, and the minimum credit score to qualify for a FHA mortgage is 580. So it's really simple to get a qualifying credit score. Now, be aware that depending on the lender that you might use, they probably will have a higher credit score requirement. I've seen lenders in the past that require a minimum of 620 or even a 640 for an FHA 203K loan. So make sure that you ask your loan officer about what the minimum credit score is for the mortgage company that you're going with. Now, I've said this before, but I'll say it again. You're going to need a minimum of 3.5% down payment of the purchase price plus the rehab. So for example, if your purchase price is $200,000 and your rehab cost, say $50,000, your down payment is going to be based on $250,000 or roughly $8,750. If you are refinancing a home with an FHA 203K loan, you don't need to bring a down payment because the equity of the property will take care of that for you. So you really wouldn't have to come out of pocket with much except for like an appraisal fee. Finally, your debt to income ratio is going to be analyzed by your lender, and the normal debt to income ratio for an FHA loan is 47% upfront and 57% on the back end. Now, what this means, I'm going to break it down really simple to understand, so don't get confused. What that means is that on the front end debt to income ratio of 47%, your total house payment cannot exceed 47% of your gross monthly income, and your overall monthly payments of all your debt, including the house payment, cannot exceed 57% of your gross monthly income. So for example, if you make $100,000 a year, or basically the equivalent of $8,667 a month, then your house payment cannot exceed $4,073. I remember that. And the total amount of your debt cannot exceed $4,940, and that would be including the house as well. This on a monthly basis. Now, one last thing, FHA loans are only for owner-occupied properties, so you must live in the house for at least 1 year, okay? You cannot take out an FHA loan or an FHA 203K loan for an investment property or a second home. It has to be the house that you're going to live in. And if you guys lie that, you are going to live in the property and in fact, you're just going to rehab a property to fix and flip it, then you may be committing mortgage fraud. So don't do it. But if you guys have seen videos online about house hacking, then really the 203K loan can set you up to house hack like a freaking pro. I actually had a client of mine purchase a 3-unit multifamily home back in 2002 for $375,000. And let me tell you guys, this property needed roughly about $80,000 worth of work. It was in pretty bad shape, and it was an older house already, like built back in the 70s. So nothing had been done to it for a long time. It needed a lot of work. So she financed roughly $440,000, and the payment was around $2,900. This was with the taxes, the insurance, and the PMI. Now, once we did an appraisal, the house came back with an after repair value of $520,000. What this means is that after all the work was finished, the appraiser projected that this house was going to be worth $520,000. So she built $80,000 in equity by doing this. But this is not all. Remember, this was a 3-unit property. She moved into one of the units and rented out the other 2 at $1,700 a month each unit. The payment was $2,900. The tenants were paying $3,400. So not only did she get to build $80,000 of equity, but also she was living pretty much for free, because the tenants were paying for the house basically, and she was cash flowing $500 a month. Guys, let me tell you, I've been doing mortgage lending for 13 years, and this was one of the best house hacks that I've seen. So finally, guys, I want to talk to you about how much money you need to have in order to make it all happen. So by now, obviously, you know that you're going to need the 3.5% down payment of the purchase price plus the cost of the rehab. Don't just do 3.5% of the purchase price like it's normal with a regular FHA loan. You have to add the rehab cost. So in addition, just like with every other real estate process, you're going to have closing costs. Now, these are basically the fees of buying a piece of real estate, and every state is a little bit different. So your closing costs are going to be different depending on whether you live in Florida, you live in California, you live in Arizona, etc. But I would say that roughly the closing costs on average tend to be about 3% of the price of the house. Now with the 203K loan, there are going to be a couple of additional expenses that you need to be aware of. If you do the standard 203K loan, which is the one that exceeds the $35,000 in rehab, you are going to have to hire a HUD consultant during the loan process, and this is going to be a requirement by your mortgage lender. Now, the fee to hire a HUD consultant is going to range anywhere between $400 to $1,250, and it's going to change based on the scope of work. So if you're doing something major, you're going to need $100,000, $200,000 of renovations, then the HUD consultant fee can be even higher. So think about that. Now, the other fee is going to be a general contractor fee. If you're doing a lot of work to the property, you're going to need to get a scope of work from a GC, and some general contractors can charge you just to give you a scope of work. So keep that in mind, put that in your budget. Remember something, guys, and I actually didn't even say this before, but you are not allowed to do work to the property, okay? Your lender is not going to give you money for you to do whatever it is that you're looking to do. You're going to have to hire a general contractor for the most part, or somebody licensed, depending on your state. For example, I live in Georgia. Somebody who is not a general contractor cannot do any more than $2,500 worth of work in this state. So just be aware of that, and you need to talk to your loan officer about the requirements for the contractor. But for the most part, I tell my clients that they are going to need a general contractor to do the work. Now, finally, even though it's not a closing cost, if during the rehab process you're not able to live in the house, maybe because it's just too dangerous or not even possible for you to occupy the property, that while you're doing the rehab work, you need to consider your living arrangements and also being able to pay the mortgage, because the mortgage payments will start to come due roughly about a month after you close, whether or not you are living in the property. So I personally advise all my clients who are looking to do extensive rehab on a home to have at least 3 to 6 months of payment reserves. This way, if you are unable to live in the house while you're doing all the rehab, you have the money to keep paying for the mortgage. So, what this means is if your house payment is $3,000 a month, then I will have anywhere between $9,000 to say $18,000 in the bank somewhere, just in case the rehab takes longer than I anticipated. All right, guys, this is it. This is the end of the video. Hopefully I gave you one tool, something to think about if you're looking to buy a house in this sucky, crazy real estate market of 2025. I know things are not great. Interest rates kind of suck. There's not a lot of inventory, but by using this FHA 203K loan, you might be able to make up inventory. So I welcome any comments, any questions. Put them here in the comment box below or in the description of this video. I'm also going to put my contact information. You're more than welcome to call me, email me, even text me, or visit us on our website and just ask any questions. Thank you for watching, guys. I'll see you soon.